Good morning, everybody. Thank you for joining us for AXA's first half of 7 financial results. Participating in today's presentation are Henri de Castres, Chairman of the Management Board, Denis Duverne, Claude Brunet, and François Pierson, members of the Management Board. We'll hold our usual Q&A session after this presentation, and priority will be given to questions in the room. We would like to draw your attention to 2 points regarding our financial statements, which are the following. 1H06 numbers have been restated to reflect AXA's exit of the Dutch insurance market and the reclassification of the perpetual subordinated debt from debt to equity. And second, the definition of on a comparable basis in our numbers is as follows. For activity indicators, we compare AXA plus Winterthur in 07 to AXA plus Winterthur in 06, and for the earnings, we compare AXA in 07 to AXA in 06 on a standalone basis, all of that at constant foreign exchange, of course. Now, I would like to turn it over to Henri de Castres, Chief Executive Officer of AXA. Thank you.
Thank you, Etienne. Good morning, ladies and gentlemen. Happy to be with you for this half-year presentation. As you will see from the numbers, this first half is a strong and solid one, showing that we are well aligned with our 2012 ambitions and showing that the group has a good momentum, which we expect is going to go forward. So if I start to go through the numbers, what has been the key environment and what are the numbers? We've been, for this first half, in an environment where we have been starting to see higher interest rates, which for us long-term is certainly not a bad situation given the strong development of the businesses and the positive cash flows. We've been seeing, at least until the end of June, quite favorable markets, but we've also been seeing slightly less favorable things. A fair amount of natural catastrophes in Northern Europe, in the UK with the floods, which have been affecting us, and we'll come back to that later. And at the end of the first half, or to be more precise, at the very beginning of the second half, we've been seeing some concerns emerging about the US subprime market, as you all know. Another element of context which is not to be neglected, because if it's not affecting this year, it's starting to shape the middle and long-term future of the industry, is what has been happening on Solvency II, where, as you know, we had been voicing concerns or expectations since a year, and we think that what we start to see with the first proposal of the Commission is going in the right direction. And by right direction, we mean a framework where the purpose of the directive is going to be to create a more competitive and more transparent industry in Europe, driven by where the solvency is going to be driven by the economic capital needs, recognizing the benefit of diversification, which we think is exactly what should happen and what we are looking for. So in this environment, what are the numbers telling us? You know that it's the first half where we fully integrate Winterthur. So there is a strong growth in total revenues, in total underlying earnings, in total earnings. So total revenues are growing by 24%. The NBV is growing by 21%. Underlying earnings are growing by 29%. Adjusted earnings are growing by 21%, slightly less because, of course, given the constraints of the purchase gap, there are no capital gains to be extracted from Winterthur at the very beginning of the period. The integration of Winterthur is very well on track. We really can say that it's a business where we've had absolutely no bad surprises, but on the contrary, we've inherited good teams, good businesses, and we'll discuss that slightly later. But we are extremely happy with what we have. And the pieces which we were not willing to keep, as you've seen, we've been selling them at very good prices and at quite efficient pace. Last but not least, all this shows with the other strategic developments that we are well aligned with our 2012 ambition, whatever, I would say, the noise around the environment. So if I go slightly more into the details, and Denis will go naturally one step further, if you look at the APEs, on the life and savings side, you know that to reach 2012, we have to be between 7 and 10%. The APEs have been growing for the first half at 11% on a comparable basis, which we think is a good number, especially when you look at the details and when you look at what has been happening in the various countries. There are clearly two countries which have contributed, I would say, less than usual to the performance in the French market because of the elections. And July there seems to be going, I would say, back to a more exciting trend. And Japan, where there are some specific market, not AXA related, but market issues. We'll discuss that further later. So new business value has been growing by 9%, slightly less than the APEs. Why so? Two elements. I mean, the business mix is a favorable one, but the geographical mix is slightly less favorable. We have been growing faster in the countries where the margin was below the group average. So this is explaining a portion of the spread. The second element is there is a temporary element in the US business due to the life business, which has been slightly affecting the number, but nevertheless, it's a solid growth of the new business value. If we look at the combined ratio, I was just telling you that the natural catastrophes have been affecting us. And as you know, we have a policy where with AXA Cession, we keep the retentions at levels which are probably slightly higher than higher than the competitors who do not have our diversification, our size. This semester, we are probably paying the price for that to a certain extent. The combined ratio is deteriorating by 1.6 points. Having said that, A, it's still way below 100%. B, the impact of the natural catastrophes is approximately 3 points, 2.9 points, which shows that if we hadn't had the catastrophes, the underlying trends remain very good ones, and I see that as very positive as my colleagues of the management board, because this is achieved with a situation where the growth in revenues is 4%, which at this phase of the cycle is a pretty good performance. If you look at the net inflows in the various key markets, everywhere we have very significant net inflows in the businesses, especially motor and household, and we see that as an illustration of the competitiveness of our businesses. So the property casualty business remains a very good business. On the asset management side, it remains an extremely strong performance, 22% increase in revenues, underlying cost income decreasing further. As you will see, a very significant net inflow. Both AXA IM and AllianceBernstein have been contributing to the performance, which there too shows that the business is in really good shape. All this is contributing to a very solid growth in underlying earnings, with, for the first time, a significant Winterthur contribution. Underlying earnings, as I said, on a total basis are growing 29%. On a comparable basis, 19%, which we see as being good. Importantly, because I would say in the past, I would say now in the remote past, some people were telling us, okay, fine, your earnings are growing, but they are very much depending on two core engines, which are the US and France. The US and France are performing extremely strongly, and that's nice. But as you see, we have now, with Northern Europe, with Asia Pacific, with the Mediterranean region, with the asset management, with the UK, diversified sources of earnings growth. On this chart, the only one which has an evolution, which I would say is disappointing, is UK and Ireland. But this is, of course, the outcome of the natural catastrophes. If you were to come to a more normalized pace, you would see that the UK and Ireland are also now significant contributors. So this is really the illustration of the policy we have, which is to diversify the sources of income geographically, always staying in the same financial protection business. Adjusted earnings, good picture too. They are progressing by 14%. Why not more, and why is it 14 and not 19 like the adjusted earnings? I already mentioned the reason. Because of the purchase gap, the Winterthur assets have been booked at their price at the 31st of December. Therefore, structurally, at the beginning of the period, you shouldn't expect us to extract capital gains from the Winterthur portfolios. Nothing wrong with that. It doesn't change anything to the economic value of the business. On the AXA side, we've been extracting a little more than 700 million of capital gains during the first half, which is very similar to what we extracted last year. If you compare that with, I would say, the indicative range we are giving every year and what we achieved last year, the range is 800 billion. What we've achieved last year is 1.1 billion. You will see that we can be quite relaxed as far as the performance of the second half is concerned. Underlying earnings per share, they are absolutely in line with Ambition 2012. They are progressing by 14%. They are affected by a slightly negative element short term, but which I see as a very mechanical one, which is the fact that the disposal of the Dutch business and the disposal of the US Winterthur business have been, quote, costing us 2 points. So on a sort of normalized basis, it would have been 16%. You know that the long-term goal is 15%. There we are, I think, fine. Adjusted EPS, which are the basis, I would say, for the dividend distribution, good growth at 1.58. I would say boding well for what's going to happen at the end of the year. So if I come back beyond the numbers to where are we operationally, Winterthur integration, very well on track. I would even say very well on track. The restructuring is well underway. And frankly said, even if there is still a lot of work to be done, the restructuring itself and the extraction of the expenses saving is not a real concern, because this is, I don't say it's easy to achieve, but we are absolutely confident that we will achieve them. The key element remains, and it's where the energy is concentrated. How can we, in places like Germany and Switzerland, accelerate the growth of the Winterthur businesses? And there we are working at new products, reinvigorating the distribution systems. On the restructuring, the former Winterthur headquarters are closed, so which shows a very rapid extraction of the synergies. The social negotiations, which were a concern to some of you because most of the businesses are in Europe, have been going forward extremely well. Everything is on track in terms of numbers. Everything is fine. The organic growth of the group and the organic growth of the Winterthur businesses is in line with the expectations. As you've seen, the top line growth is exactly what we expected in the plan, and the profitability is consistent with the past experience. So the important element, as I said, is I would say the addition of further growth within the system. For that, we have to put in the Winterthur networks new AXA products. We will have the accumulator variable annuities introduced in Germany, or we have them introduced in Germany and in Spain in the Winterthur networks. We are working in Switzerland on individual life, on the property casualty portfolio, to bring AXA products to, on the property casualty side, be successful with the renewal season, which is happening in Northern Europe between September and January. So there, I would say everything is on track and going forward. If you look at the synergies, we have it extracted during the first half, approximately already 2/3 of the synergies we were expecting to extract for 2007. And as far as the restructuring charges, restructuring costs, consumption is concerned, we are also very well aligned. Winterthur was not the only thing we've been busy with in the first half of 2007. We've been working on distribution, we've been working on products, we've been working on risk and capital management, and we've been working on human resources. As we've said, all this is part of the 2012 initiatives. What has happened there? We've continued to build the group presence and the group reach in terms of distribution. If you look at the key things we've been saying, which are things which should, I would say, positively contribute to the growth in the years to come between now and 2012. We see the agreement with Monte Paschi Vita in Italy as a quite fundamental one. This is giving us an access to 8% of the life market in Italy. Many people were telling us that in Southern Europe our presence was, I would say, underweight. With this agreement, we think that we have now a very good footprint in Italy, and the cooperation is working extremely well. We think that in this market, the introduction of the accumulator product distributed through our own networks, but also distributed through the joint venture we have with Monte Paschi, is going to be a quite powerful proposition. Second point, probably, I would say, slightly more, quote, unusual, even if it's absolutely within our core business, but it's not, I would say, unusual. It's a new step. We are confident enough to say that we have to look at emerging markets which are starting to normalize themselves in terms of market behaviors. Ukraine, for us, was a very intriguing case. And we have convinced ourselves that this would be a growth market, first on the property casualty side, and then on the, for the longer-term future on the life side. And as you've seen, we have announced 2 deals which are now putting us in a market leadership position. We are number 3rd in the Ukrainian market, given the 2 deals we've done with BNP Paribas. Just to give you a slight indication, in terms of automobile insurance, the liability coverage is not compulsory in Ukraine, was not compulsory in Russia a couple of years ago. It's now compulsory in Russia, and 85% of the drivers are complying with the law. If you have the same thing happening in Ukraine, it's going to be a fast-growing market. Last but not least, in the Mediterranean countries having good economic growth, we already have a very strong presence in Turkey, which is a very big market. We have had this opportunity to have a partnership with Alpha, the second largest Greek bank. And the agreement is another illustration of the fact that AXA is now, for banks looking for a partner in terms of insurance or financial protection products, it being either life or property casualty, a quite attractive brand name. I mean, if you look at Monte Paschi, Ella, a couple of other things, you see that we are now quite powerful there, and that to do that, we don't need to buy the bank. On the distribution side, the other elements which are interesting, we've been expanding the agents network in France through the agreement François has just signed with National Suisse Assurance. It's giving us 150 additional agents. It's giving us 250 additional brokers. It shows that we are confident that these distribution channels are going to remain competitive in the future, and it's increasing our reach, increasing our scale. Last but not least, a significant number of things have been going on in the UK and also in the new distribution networks. In the UK, we've been acquiring brokers. We have been also acquiring Swift Cover, which is an internet distribution in automobile insurance. In the new channels, we've been acquiring not only Swift Cover, but also Kyobo Direct, which is the largest direct insurer in Korea. It's for us an opportunity to penetrate a very large market in Asia with a good business. Last but not least, in Hungary, we have acquired a small banking platform called Ela Bank, which is going to help us build our presence in this country the way we've been building it with AXA Bank Belgium, meaning the banking platform, which is an elementary one, is helping us attract the savings and then transform them into long-term products. This was for the distribution. So you see geographical expansion, expansion in terms of new distribution channels, and reinforcement of the existing platforms. Now product initiatives, more than ever. The variable annuities and the variable annuities with guarantees are a competitive advantage, and we are leveraging our presence, our success in the US to other territories quite successfully. We've been launching the yen VAs in Japan in January. We've been launching in France and in Spain different versions of the same core product in March. And it has been done in Belgium in April. It has been done, it's just starting in Italy since May. There are 5 launches which are now on the list between now and the end of the year, and 3 additional ones for the beginning of 2008. It's one of AXA's competitive advantages to be innovative in products and to have the ability to replicate them in other markets when it works somewhere. We use it, and we want to use it at an accelerated pace. Risk and capital management initiatives. In terms of capital management optimization, we've been selling some non-core businesses, the US business from Winterthur, but also the Dutch business, and not only the Dutch business from Winterthur, our own Dutch business. The management board is quite pragmatic when it comes to an approach to the businesses. What we want to do is really to make a difference. To make a difference, you need to have really efficient companies with an ability to grow your market share faster than others and with a critical scale. The issue we had in the Dutch market was not that the teams were bad, the teams were good, but the business was too small in a small market. So the Winterthur acquisition gave us the opportunity to have something slightly bigger to sell because it was still too small for us and didn't give us, I would say, any reasonable chance to be among the leading forces in the Dutch market for the middle term. We've sold it. We think it's good, I would say, business to do that. As you've seen, we have redeployed the capital in territories where the growth is going to be higher and where the market position is going to be stronger. We've been returning 3.1 billion to shareholders in the form of dividends, share buybacks, and cancelling the impact of the dilutive instruments, the dilutive convertibles. And we have, as you will see later, further plans in this direction. We've been managing our risk profile with a third very innovative initiative, which is the second securitization of the European motor portfolio, which represents 2.6 billion in premiums. We have the very deep belief that this is a market which is going to expand quite strongly in the years to come. We are preparing actively Solvency II. What does this give at the end of the day? We've been upgraded in terms of rating by Standard & Poor's, and the risk management of the group has been recognized as excellent, which I think should give to the investors a high level of comfort as far as the turbulences are concerned. Last but not least, in terms of HR initiatives, we had mentioned that at the year-end conference for the year-end earnings, but now it's done. Every AXA employee is now shareholder. As you know, the shareholders have accepted us to give 50 shares to all the employees now in recognition of the fact that for 2005 and 6 we are ahead of the 2012 plans. It's done. The way it has been received within the group is great. The employees are very excited about it. They are now focusing on the right things. Not that they were not before, but I would say more than before. They are focusing on the right thing. They are very interested in what's happening. And they know that 50 additional shares will come in 2009 if we are still on track in 2007 and 2008. But being on track means earnings and customer satisfaction, which is, I would say, forcing a greater attention paid to customer satisfaction, quality of service, which I think is the big mountain we have to climb, because the quality of service is not where we want it to be. If we bring it where we want it to be, it's going to lead to more market growth, better retention, and better earnings, of course. So that's where we are, and Denis will now go into more details as far as the numbers and the initiatives are concerned.
Thank you, Henri. Good morning, everyone. I'd like to go through the performance of the first half in more detail, and then we'll talk about the balance sheet at the end of June. First half performance. This slide is busy, and I will not go through the numbers because they have all been presented by Henri. This is just to remind you that, as Etienne has indicated, activity indicators are compared on an AXA plus Vintotur basis for 2006 and 2007, whereas because we were not able to rebuild IFRS numbers for Vintotur for the first half of 2006, separating underlying adjusted and net income, we are comparing on an earnings basis AXA solo performance 2006-2007. Going to slide 25, all of our operating businesses contributed positively to the underlying earnings performance of the half year. Life and savings went up 19% on a comparable basis. Property casualty, for reasons that have already been outlined by Henri, went up only by 6%. Asset management, a very solid performance at plus 27%. The reason it's higher than on a reported basis is that we were affected by the weaker US dollar, which is the currency in which AllianceBernstein reports. International insurance went up 70%, producing this plus 19% performance on a comparable basis. On the activity in life and savings, again, double-digit APE growth, a growth of 11%. I'd like to make a few comments on the numbers, not all. The proportion of unit-linked went up to 52% compared to 49% in the first half of 2006. And I want to comment the larger territories. US was up 21% on a comparable basis. This is made up of a very creditable plus 15% number for the variable annuities, and an accelerated growth of 64% on the life side, which I will comment later. In France, the performance on a comparable basis is only plus 2%. This is the combination of plus 32% on the group business, where we had a very strong first quarter, and minus 10% on the individual business, where our business was affected in line with the rest of the market by the fact that people were in a, both the fact that they didn't have the incentive to move away from banking products to insurance savings products, different to last year, but also by the fact that with the presidential election, people were in more an expectative mood and waited to hear what was going to happen in terms of inheritance tax. We are catching up on this because our performance in July in individual business was plus 25%. Japan, weak performance at minus 16% of APE. This is largely a function of the fact that last year we had very strong sales until March, because Japan, the first half ends in March, of long-term private accident product, which was a product which was very strongly tax advantage, and the tax advantage disappeared. And also we reduced sharply the sales of single premium annuities, fixed annuities to the banking channel to replace them with variable annuities, and the take-up of variable annuities has been a little bit slower than we expected. In the UK, very strong performance at plus 26%, which is a combination of strong sales of offshore bonds and strong sales of the enhanced AXA plus Vintotur proposition in the individual pension market. And in Australia, which is the other very strong number, strong flows in the superannuation to the end of June, because there was a strong tax incentive to put this money before the end of June in Australia. The new business value growth of 9% is the combination of an APE growth of 11% and a slight decline of half a point of the APE margin to 21.9%, producing a 9% growth of the new business value. The new business value in the first half of 2007 is calculated on the end of 2006 economic conditions, because we believe it's very difficult to comment the changes during the year if we also review the economic indicators used to calculate the new business value. So what happened to this new business value, and why did it slow a little bit in first half of 2007? Two factors. The business mix continued to improve both in the old AXA perimeter and in the Vita2 perimeter. But on the AXA side, this was offset by a slower growth of a few high-margin countries, and I will now comment that on the next slide, which is slide 29. In the US, you see that the APE margin went down by 2.2 points. This is not due to the variable annuities, where the margin have remained quite solid. This is entirely due to what happened on the life market, and more specifically on the universal life products sold through the wholesale channel. I told you about the plus 64% performance on the life side. In fact, this performance was plus 139% on the wholesale of life business. And you may have seen articles in the US press on stranger-owned life insurance or investment bank slicing and dicing life policies, which are bought from policyholders. We were, in a sense, the victim of that phenomenon. We saw that coming over the last year, but because of the complexity of the US regulation and the fact that we have to get approval for our new products in 56 jurisdictions, it took us the good part of a year to get a new product in place, and this happened only at the end of June. We saw that in our wholesale channel, our policies were sold disproportionately to people age over 70 years of age, and seeing that and we tried to discourage that, but we were not able to fully discourage that, and we have repriced the product at the end of June, but we have also, looking at this retrospectively, decided to change our assumptions and decided to expect that we will have no surrenders of those products, and this changes the profitability to a new business margin of the order of 5%. In Japan, you see that in spite of a minus 16% on APE, we have plus 1% plus 10% of new business margin. This is thanks to changes in business mix. We've increased our sales of medical products, which have a higher margin. In the UK, it's a combination of more volume overall, more success in our sale of protection business, and less group pension, which is one of our products with the lowest profitability. In Germany, an increase of the margin of 4 points, which is the continuous positive impact of our sale of the Twin Star product, the variable annuity with secondary guarantees, offset by some volume effect and the life reform, which is called VVG, which will have an impact on the profitability negative impact on the profitability of traditional products. And finally, in Hong Kong, a drop of margin of 7.9 points, which is attributed to a change in business mix. We sold more group business, which is less profitable, and more savings business, which is also less profitable than traditional business. So when you look at it overall, you see that we have a decline of margin of 0.5 points, which is entirely attributable to a decline in margin in the US and in Hong Kong. Those countries have a higher margin than the group overall. And as Henri indicated, this is the change in the business mix that had this impact for the first half. I believe that this is essentially a temporary phenomenon. The earnings growth of 19% on the life side was the result of earnings growth in all of our territories. I will not comment that slide further, and I would like to move to the next slide, slide 31, where you see our usual analysis, our usual margin analysis, where you see that our gross margins continued to grow in the first half of 2007 by 12%. Essentially, as usual, thanks to a very strong growth of the fees and revenues, because the proportion of, because our sales grow in general, but also because we have a higher proportion of unit-linked business and market performance was good. The expenses went up 11%, largely driven by commissions. Taxes were flat because of positive one-off tax effects. All in all, the expenses and tax went up 9%, so we continue to have a positive scissor effect with gross margins growing faster than our expenses, leading to a 19% growth in the underlying earnings. I'd like to move now to property casualty, and you are now used to this slide with flags representing the various countries in Europe where we do business. And this is representing the renewal pricing trends. We usually show that once a year. This year we decided that it made sense to show it also at the half year. And you see again a contrasted picture in terms of pricing trends. You see first that in motor we continue to see downward pressures everywhere except in the UK, where the cycle has turned and we see price increases. In household, you see that most countries have positive price evolution in households. The exceptions are the UK and Ireland, and I believe that given what is happening in terms of flooding, you should expect that prices in the second half in households should increase. On the commercial side, you see that we have a mixed picture on property and liability, but more positive signs, positive movements than negative. We see a lot of competition in the on the commercial lines. The UK, again, on property, you should expect that with the floods, the prices should turn positive. And so a lot of competition, but some positive moves in a number of territories as well. We had a good sales performance in the first half of the year. I'm on slide 33, with a growth of revenues of 4%, which was slower in commercial lines and at 3% than in personal lines at 5%. In personal lines, we continue to have very strong positive net inflows, more than 630 new cars, net new cars in motor, more than 180,000 net new homes in households. So we continue to gain in terms of portfolio in personal lines and to a lesser extent in the commercial lines. Our combined ratio moving 1.6 points to 98.4 was affected by the weather events. When we decompose this combined ratio, you will see that we saw a growth of the loss ratio for the reason I just indicated, but also a slight increase in the expense ratio. The slight increase of the expense ratio is made up of an improvement or reduction in the administrative expenses and a continuing growth of the acquisition expenses driven to a large extent by the UK and in the UK and other territories, changes in the mix of business towards business with lower loss ratio and higher commissions. And the impact of the weather events, the Kirill storm in January was 224 million. The UK floods in June, 115 million. The overall impact was 2.8 points. for the total. You see that the impact is very significant in the UK, Germany, Belgium. The countries that were not affected were France, which saw a good decline in the combined ratio to 97.2. Southern Europe, a strong decline in the combined ratio by 2.5 points, and other countries also performing quite nicely. In spite of this increase in the combined ratio, we saw a 6% growth of our underlying earnings in P&C. This is driven by a good net investment income, which was the result of both higher asset base and higher asset yield, showing the success of our initiative to improve our investment margins. And there was also non-recurring tax benefits of 85 million due to reduced taxes in the UK and Belgium, and the resolution of a tax audit in Germany. If you look on a country-by-country basis, we had a positive evolution of our earnings, underlying earnings in P&C in all territories except the two that were most affected by the weather events, UK and Ireland and Belgium. Moving to asset management, we have seen a continued increase of our asset basis in our asset management businesses by 14%, which is the product of a number of factors. Very, very strong net inflows, 33 billion euros, coming almost half and half from the two businesses. Market appreciation for 48 billion euros. The transfer to AXA Investment Managers of 61 billion euros of assets coming from Winterthur, and the negative impact of foreign exchange for 17 billion. We continue to have higher average assets under management during the period, plus 22%. And you see again that there is a strong contribution to this asset base of third-party asset management flows. Third-party assets under management moved up from 688 to 758 billion euros, whereas the assets managed for the insurance companies moved from 341 to 395 billion euros. Looking now at each of our asset managers one by one. On the AllianceBernstein side, the activity was driven by international clients, which are now representing 38% of the client base. Global funds with global and international funds representing now 58% of the asset base, and blended management styles, so the blends of growth and value. The revenue growth was 19% in euro terms. The productivity improved with the cost-income ratio declining by 0.7 points and translating into the 21% earnings growth on the Allianz side. Moving to AXA IM, the growth reflected the success of the multi-expert model with growth coming from various geographies, various channels, and significant growth of both in quantitative equity, the AXA Rosenberg plus 19%, fixed income plus 17%, real estate plus 19%, structured finance plus 6%, and the other disciplines, mainly equities, plus 19%. You see that the assets under management at AXA Investment Managers at 566 billion euros are very close to the assets under management at AllianceBernstein at 588. On the earnings front, revenue and earnings front, the cost-income ratio of AXA Investment Managers declined by 2.9 points, translating into a 35% growth in the earnings, which makes it now a very solid contributor to the earnings of the group. Moving quickly now to the other segments of the underlying earnings, we see that in the international insurance, we had a growth of 70%. This is made up of a growth of 33% at AXA Corporate Solutions, which had a good performance in the first half with a stable combined ratio and solid growth. The other international is, to a large extent, an improvement on the boni on past years, so positive development of reserves of AXA Liabilities Managers, which manages all the run-off portfolios of AXA, but also a good contribution of AXA Assistance. On the other financial services and holdings, a stable result. The positive evolution on the holdings side is coming from the fact that we are hedging our non-US denominated earnings against the negative variation against the euro through options. The main currency is the US dollar. We have hedged our 2007 earnings on the basis of $1.28 for 1 euro, and we marked to market the option that is covering our earnings for the full year at the half year to get the translation, the currency translation profits in our first half results. And this is what explains, to a large extent, the fact that the underlying earnings of this segment are flat. Moving to next slide, from underlying earnings to net income, you see that we have capital gains that were roughly stable in the first half 07 compared to the first half 06 at 736 million euros. I need to remind you at this point that all the capital gains were coming from the AXA side, because we marked to market as part of the purchase accounting the Winterthur asset portfolio, so we had no capital gains from the Winterthur side. This also explains on a per share basis why our adjusted earnings per share go slightly less than our underlying earnings per share. Moving from the adjusted earnings to net income, you see 5 lines here. The profit and loss on financial assets under fair value option and derivatives, which is minus 182 million this year. This is entirely driven by the increase in the interest rates. There was a similar phenomenon last year with also an increase of interest rates in the first half. And so this is this is quite normal. Integration costs of 64 million euros, essentially driven by Winterthur. Exceptional operations, a slight negative of 17 million compared to a strong positive last year. Last year we had a dilution gain on Alliance Bernstein. Discontinued operations, this is the reclassification of the Netherlands operations into net income because we are selling them in the second half. Goodwill and related intangibles, a bigger negative this half year because we have to amortize the value of the client base, called customer intangible, and coming from Winterthur and coming from the acquisition of the UK brokers. Moving now to the balance sheet, shareholders' equity went down by 1.5 billion roughly. This is essentially the impact of the increase in interest rates, which is a minus 1.8 billion. I will come back to that in more detail. The payment of the dividends in the first half. First half net income is producing an increase of 3.2 billion. We had share buybacks for 650 million euros in the first half to offset the dilution of stock options and our share plan. And this is why our shareholders' equity went down. But the decline is almost equivalent to the decline in the fair value of our bond portfolio, which I will now comment further. The impact of the increase in interest rates was negative on our equity base by, as I indicated, 1.8 billion euros. But from an economic standpoint, it is neutral our group economic value. To comment the left-hand side of the slide, you see that our unrealized capital gains attributable to the shareholders moved from 9.6 billion to 8 billion. 2 billion is coming from the real estate portfolio and is not in the equity. 6 billion, which is in the OCI, in the equity, is a combination of -1 on bonds and +7 on the equities. So our equity portfolio continued to perform well, but the revaluation of our bond portfolio was a significant negative with the increase in interest rates. We believe that from a value standpoint, you don't need to worry about this. Basically, our European embedded value change resulting from the increase in interest rates is 0. Coming from the plus 60 basis point increase in the long-term interest rates. There is a negative impact on the other than life unrealized capital gains of -0.4 billion. This is an estimate. And then there is a net positive change of the mark-to-market of the debt, which completely offsets that -0.4. So the net impact on the economic value is of this increase in interest rates is neutral. Very quickly, our life and savings reserves increased by a modest 3%. We had strong technical operating cash flows in our life businesses of 7 billion euros, a negative foreign exchange impact of 4, market appreciation of 10, and we excluded the Netherlands 10 billion because we are selling this business in the second half. And you see, if you look at the makeup of those reserves, that the proportion of unit link continues to increase because this is the piece that is increasing. The rest is flat or declining. On P&C reserves, our reserving positions remains quite good. Claims reserves to claims paid, we are at the same level as at the end of the first half of 2006, which shows that the Winterthur businesses are reserved on the same level as the AXA businesses, and that we have not changed the strength of our reserving position during the first half of 2007 to offset a negative claim environment. Net technical reserves to net earned premiums, 203%, a number slightly higher than at the end of June of last year. I'd like now to comment briefly on our asset base because we have noticed the decline in our share price in the recent weeks, and I'd like to give you some comfort that we are managing our assets in a reasonable way. First, you will see that basically our asset allocation has not changed compared to a year ago. Fixed income represents 75% of our assets, listed equities 11%. And we have alternative investments for 3% and cash and repos for 4%. I will now concentrate on a few asset classes that are giving some concerns to the investor community, which represent about 6 billion of this total. The first topic is U.S. subprime residential mortgage-backed securities, and you will see that we have a low exposure to U.S. subprime. At the end of June, the market value of our U.S. subprime portfolio was 2.2 billion euros, with strong credit quality, no downgrades to date. We have 92% of these assets which are AAA and AA rated. The mark-to-market at the end of July was 98.6% of par, so a very small decline in the value. If you look at the vintage 2006-2007, which is probably the vintage that gives rise to the most questions, 99% is AAA or AA, with 90% as AAA. In terms of the potential accounting impact, you need to know that the policyholder participation is roughly 55%, and from an accounting treatment, you know that we have elected to put most of our assets in the category of available for sale through the OCI, and we have 17% that are available for sale through the P&L. So in a nutshell, we have very strong credit quality, stronger credit quality in recent vintages, significant policyholder participation, and a small proportion of the assets that is going to be flowing through the P&L. Just a little more granularity on the vintages. We believe that, well, as you saw, 92% is AAA and AA tranches. The cumulative losses on vintage 2006 do not impact the AAA and AA tranches, and the projected cumulative loss on vintage 06 and prior years do not impact the BBB tranches. So we are quite confident that this is not an issue for AXA. Now moving to the CDO exposure. Our CDO exposure is 1.6 billion euros. We have not seen any recent downgrades. The mark-to-market is slightly more affected because the mark-to-market at the end of June is 85% of par. This is the results of the current liquidity crisis. This has nothing to do with the credit quality of the portfolio. Policyholder participation is roughly 43%, with an accounting which is 63% AFS OCI, 37% AFS P&L. And you see that the proportion of investment grade is significant in those assets. And below investment grade represents 54 million euros, equity and non-rated 500 million euros. On the CLO exposure, the collateralized loan obligations, our exposure is 2.4 billion euros. We have more than 70% of the assets that are almost 78% of the assets that are investment grade, and the non-investment grade assets are quite diversified, with more than with close to 2,000 investments and none exceeding 10 million euros. So we are quite confident on this part of the asset portfolio. The accounting treatment is 58% OCI, 42% P&L. Policyholder participation rate is roughly 34%. CLOs, we don't believe it is a problematic category, in fact, because those loans have covenants, which is different from the CDOs, and we don't believe there is an issue in that asset category. I have to add that those portfolios are managed by the Structured Finance Division of AXA IM, which has an extremely strong performance to date, and we are quite confident that this category of assets is not an issue for us. And I'd like to focus now on something that has been mentioned in the press in the recent weeks, the AXA Investment Managers LIBOR Plus funds. We have two funds called in the AXA World Fund family and AXA FIRS, another fund managed by AXA IM. So the two funds are called AXA IM LIBOR Plus. The objective of those funds was to beat the LIBOR index by 50 basis points. The net asset value of the portfolio is roughly 500 million euros and has declined between 20 and 25% below par. There is no leverage within the funds, no guarantee on capital invested in the funds. The fund is essentially invested in US subprime and Alt-A portfolios, which represent roughly 80% of the portfolio, and this explains the decline in value. We have seen no credit events in the portfolio so far, no downgrades, but because of the lack of liquidity and the impression at the market that this is a problematic asset category. We have an issue in terms of mark-to-market. What the decision that we've made was to offer liquidity to fund shareholders. We have advised the fund shareholders to stay in the portfolio because we believe that this liquidity crisis is temporary. But for those people that wanted to move outside of the funds, we have offered them liquidity. And at the end of July and the beginning of August, AXA IM has bought back roughly 300 million euros of these assets. We believe it was the right thing to do for our unit holders, because the ones that want to stay won't be impacted by the fact that some people have decided to move out. This is, we believe that for those kinds of funds, it's better to offer liquidity than to close the fund. Moving to our position from a debt standpoint on page 57, our total debt has remained stable during the period. We have a maturity which is quite extended, with 7.4 billion of our debt which is undated, and a very strong liquidity position with 17 billion euros of cash and 6 billion euros of undrawn credit lines. Our solvency position has remained very strong at 180%. We are committed to keeping it strong, and our S&P financial strength rating was updated from AA- to AA during the period. Lastly, we have. Did I miss a slide? No. Lastly, we issued our second motor securitization. The first one was on the French portfolio in November 2005. We did one on our European portfolio more recently in June and July. On portfolios from Germany, Spain, Italy, and Belgium, we can demonstrate this way the very strong benefit of diversification, which is between 30 and 40%. When you look at the situation, the securitization will have a positive impact on our required capital, particularly in the Solvency II framework. The net cost of the securitization was 59 basis points. And when you look at the capital requirement, the Solvency I requirement is 16% of premium. Here, the equity tranche was 3.5% of premium. This is the risk that AXA has retained. We've securitized the rest of the risk, BB, BBB, and the other tranches. And the securitized tranches represent 20.7% of premium. So the totality of the risk is covered by 24.2% of the premiums. And the equity plus the BB tranches represents just over 5% of the premium. So we believe that this is the right way to look at risk in insurance, and we believe that Solvency II will give us this benefit of diversification and also the benefit of securitization, and we are looking forward to it because we believe that's the good way to manage our balance sheet. And lastly, shareholder cash flows. This is the presentation that we have started to give at the beginning of this year. Very briefly, we had in the first half the adjusted earnings of the period of the past period, 5.1 billion, a difference of 400 million between statutory and consolidated results. We increased our local solvency margin by 2.4 billion euros, coming to a large extent from the UK and to a smaller extent from the US. We paid a dividend of 2.2 billion euros. We made acquisitions for 1.8 billion. This is Sanford Bernstein put, the acquisition of Alpha Insurance, the buyout of our partner in Morocco, UK brokers, and other transactions, making a total of 1.8 billion. And we bought back shares and the convertibility premium on the convertibles for almost a billion. We had divestitures for 1.3 billion, and we increased our debt by 1.3 billion euros. So this is a breakdown that you will probably find useful, and we will continue to provide that going forward. I will hand over back to Henri. Thank you very much.
Thank you, Denis. So now, what's the outlook? How do we see the rest of the year? Well, we are pretty optimistic on the rest of the year. Despite the market turbulences, we think we are well aligned with Ambition 2012. We don't think the current volatility in the credit markets is going to have a material impact on the profitability. You've seen what the quality of the assets was. So we don't think it's going to be a major factor for us. And if we look at the underlying operating businesses, the way we look at them is on the life side, we think the new business value is going to grow at low single, more probably, low double-digit rates, despite the fact that there has been a slight decrease in the momentum of the growth of the AP years. But as you've seen, the French market seems to be a little bit more active for the second half. So the life business should continue to be a growth business in line with the 2012 path. The property casualty business, we think that unless there are major floods everywhere in Europe between now and December, which is not necessarily going to happen, we think that the combined ratio for the second half of the year should be better, and we think that therefore the combined ratio for the whole year should improve when compared with the first half. On the asset management business, even if the markets are turbulent, we think we will continue to see significant growth in these businesses. So this aligns us with the 2012 ambition. We think that underlying earnings are going to grow at double-digit pace, aligned with the 2012 ambition. And in terms of capital management, there is one thing we wanted to say, which is that we want to use the current circumstances as a way to be proactive in what we call our dilution neutralization program. So we will buy back 45 million shares between now and the end of the year. So as you see overall, this creates a picture which is consistent with what we've said. We think we are in growth businesses. We think the growth pace of the markets in our businesses are not going to be affected by the recent turbulences. And we think that the efficiency of our operating model is enabling us to see good organic growth and to seize opportunities when we find them in various markets. What are the next steps for you? We will release the first 9 months' activity indicators November 8th, and on November 13th, we will give you an update on the Ambition 2012 progresses. And that's it, and we are now ready to answer questions for a moment. Thank you very much. So we'll take the first question from the room. The ones who are connected through the net should, when they ask their questions, give their name, please. So let's take a first question in the room, if there is one. The room is silent. Yeah. Jean. One question, Mr. D'Herbecourt.
Yes, good morning. Actually, I have 3 questions. The first one is on the combined ratio. Could you tell us about the release of reserves as the reserve ratio has declined on AXA on a standard basis, this is to say, reserve on claims paid. And the other question is more fundamental on the other point on the combined ratio is more fundamental. It looks like a combined ratio at 98.4 does not compare very well with your peers. And this is, I would say, quarter after quarter and year after year. And you told us that, well, so at the end of the day, this is not a good performance. And could you give us some visibility with regard to QIS3, where it would look like on a more realistic basis, I would say? The second question is on the contribution of Winterthur. I have some difficulty to extract a net profit contribution of Winterthur in this H107 figures. It looks like you give some like-for-like growth in terms of earnings, stripping out Winterthur's contribution. And at the end of the day, in terms of €1 million contribution, I would like to see where is Winterthur. And last, with regard to the subprime crisis with AXA IM, okay, fine, you have a very little exposure, but there is also, I would say, Fonds de commerce impact potentially, and I just would like to know beginning of August if you had any withdrawal of funds. Where do you stand in terms of inflow or outflow on the impact on AXA IM? Thank you.
Okay. Let's take the three questions. Combined ratio, Denis, do you want to answer to the decrease in to the supposed decrease in reserves?
Yes, I don't understand your comment, because what you can see is that there was roughly 1.4 points of combined ratio in terms of additional boni on past years compared to last year. So yes, we had more positive developments than past year, but even with that, I believe that we didn't reduce the strength of our reserves as measured by the ratios of reserves to premiums or reserves to claims paid. So I believe that yes, we had slightly more positive developments in past year, representing 1.4 points, sorry, of a combined ratio. But if you look at the impact of the weather events, this impact is 2.8 points. So we would have had an increase in the combined ratio of 1.4, and in fact, so our roughly our underlying performance on the P&C side was stable compared to last year, or slightly better than it was last year. The second point, comparison with peers. Yes, it is true that we have a higher combined ratio than our peers. This is in part a question of geographic mix. This is in part a question of the way the combined ratio is calculated, and this is in part the fact that effectively we need to continue to progress on our combined ratio, both from an expense standpoint and from a claims management standpoint, and we have a number of initiatives which we expect will drive a continued improvement of our underlying performance. But the gap is not what you can. I mean, the real gap with our peers, I don't believe, is 5 points, as you might think prima facie.
Do you want to answer to QIS3?
Yeah, no, I don't want to answer QIS3 because I don't think anyone in the industry has published its QIS3 figures. You will, I think it will be interesting to look at what SEIOPS publishes, or what the individual country supervisors publish as a synthesis of QIS3. I would say that we believe that the model that has been built by the European Commission and SEIOPS is conceptually right. We believe that the P&C risks are calibrated a little bit too high still, and our motor securitization is a living example of that. But overall, we believe it's a good system, and that would show, that would confirm that we are financially a very strong company. And I don't want to say more.
Jean, just to add something to what Denis has said on the property casualty side, yes, of course, we need to continue the efforts we are doing on claims and on costs. I fully agree with the fact that you shouldn't be fooled by a pure and simple blunt comparison, because the business mixes are different. The way we reserve is different. I would add something else. We've told you that we had a range for the combined ratio. We think our job is to maximize the growth of the profits on an earnings per share basis. We don't think our job is to bring the combined ratio to the lowest possible level, ignoring the growth. If you want to give the picture full, look at the growth of our competitors in terms of property casualty revenues. Most of them are stable or declining. So we prefer to have an arbitrage where we maximize the profits rather than bring the combined ratio to 90, I would say to a couple of points down, by a couple of points down, and having a growth which at the end of the day would be no growth or slightly negative growth, minimizing the profits. We think and I mean, you can criticize that, but it's our choice. We think that as long as I would say the way to maximize the earnings per share growth, it's the right decision. We are no more in the situation where the industry was years ago at the beginning of the century, where the combined ratios were 114 or something like that. At the time, there was no choice. You had to bring the combined ratio below 100. Now that you are below 100, I would say the tactics of the race, it's exactly, if you compare that with a Formula One race, let the management decide what the tactic of the race is. If you want to give us all the indications on bring the combined ratio there, bring this there, bring this there, at the end of the day, you will have a uniformized industry with an average mediocre performance. We think we are very profitable on the property casualty side. We think our distribution networks are efficient. We think the right way to maximize the profits for the shareholders is to fine-tune things. And as long as we are within the range we have indicated to you, and as long as it's the solution which is maximizing the earnings per share, or at least the earnings contribution coming from this business, we think it's the right thing to do. It would be too easy for us. I mean, if I say to François, bring your combined ratio down by 3 or 4 points, and I don't care about the growth of the portfolios, of course we will achieve that. But after a couple of quarters, I think we will have destroyed value. So I think you have to take all the elements into account, and it's the balance between combined ratio and growth, which at the end of the day is creating the outcome, and this is what is important to us.
Yeah, and just Henri is absolutely right. I should have started with that. The point I want to make is that at the current combined ratio, we are continuing to create value. We have no doubt about that. And what is important for us is whether we create value in our P&C portfolio, and we do. So that's really the key yardstick that we look at when we write P&C business.
On Winterthur, I don't understand the question, because I thought we had given on page 10 the exact amount in euros. So is there something we are missing there, Jean? It's 288. Winterthur contribution 288. Okay. AXA IM. Who wants to answer that? I mean, Denis, Dominique. I mean, we are not very worried.
We believe that what happened to US LIBOR Plus is unfortunate, and we are not happy with this situation. We believe that we have acted responsibly on this, and that this is an isolated issue. AXA IM manages 566 billion euros. We had this unfortunate situation. This doesn't this might have some client consequences. There is no doubt about that, and we will try to do our best to manage the relationship with the clients as best we can, but we don't believe that this will jeopardize the overall franchise. Dominique, do you want to add something? Voilà.
Hello. Can you hear me? Okay, good. Hello, everybody. Jean, you're asking a very good question. However, what I can tell you is that so far we have not noticed that there's a flight of money from AXA IM, and we have not noticed withdrawals, apart from the ones that we've had to face on US LIBOR Plus, of course. I think we stand very firmly on the policy we've implemented for AXA IM US LIBOR Plus for 5 reasons, which are the 5 benefits we believe our policy delivers to customers. The first one is that we gave immediate and full transparency to all our customers on the mark-to-market value of those assets. I think we were the first ones in the industry to come forward with the issue and to shed the real light on this issue for customers so that they realize what's happening to their investments. The second benefit is that we give full and immediate guaranteed access to liquidity, which I feel is a key element of the value proposition of the UCITS 3 product, which is a very efficient, transparent way of managing money for investors. The third benefit is that in doing so, we've given all the elements to clients to make their own trade-off, given their risk appetite, for staying invested in the fund or getting the cash back. The fourth one is that it gives equal treatment to all shareholders of the fund. And the fifth one is that it protects the intrinsic value of the portfolio, which from the information we've got to date has not changed in line with what the mark-to-market value tends to indicate, because we have not had any credit event in the portfolio, as Denis said. So far, I should say, the only thing that is affected in AXA IM is these 2 funds, where we've had some withdrawals, not much to report on other fronts yet. I think the tone of the conversations we're having with clients is also changing from the day we announced this new policy, because when we did that, we were among the first houses to acknowledge and communicate on this issue and take action, which I think is quite a decisive action on this issue. We are now seeing developments in the markets where many more fund management houses are announcing that they're suspending subscriptions and redemptions in similar funds. We hope that the actions we've implemented with a distance will be seen and read much more positively by clients than what our competitors are doing.
Just to reinforce what Dominique says, we think in these matters, because it's important to people, the 2 very important things are transparency and swiftness of the reaction. I think it's what we have done, and we are interested to see that, I would say, a week ago, many people were saying, oh, this is an AXA isolated issue. We see what we see. It's interesting. But I think looking backwards, people will give us the credit for having been extremely transparent extremely quickly. Okay, next question. Yep.
Good morning, Thomas Jacquet from Cheveux. There is a word I don't see in the presentation. It's credit default swap. Is it because you don't have any portfolio on in this area? And can you give us eventually more detail about that? My second question is linked to the hedging program on the variable annuities. We see a spike in volatility. Do you think this could affect the new business margin on these products and eventually the availability of the cover? Because reinsurance used to be a long-term cover and now you have to renew the covers. And my last question is about the tax rate. I calculate that it comes at 25% versus 27% last year. Can you comment on the future trend? Is it going lower and lower, despite, given the fact that you are in high tax rate countries and not...
Okay, thank you, Thomas. We'll answer to all of that. On the very last point, just to react, and then I let Denis speak. Fortunately, there are a lot of governments throughout Europe, and not only in Europe, which are decreasing the taxation rates on companies' profits, and sometimes it flows through the earnings, and I think it's one of the explanations. So we wish that more is going to come. We'll see. Okay, Denis, on all these elements.
Well, continuing on the tax rates, yes, I mean we are quite transparent. We had positive tax one-off benefits in the first half, coming to a large extent from a reduction in corporate tax rates in different countries. And this is coming to a lesser extent from the closing of tax audits. We've seen positive developments on tax rates probably in all periods in the past. So this is not something really new. We expect to have other positive tax one-offs in the second half because we've not taken into account the reduction in the corporate tax rate in Germany, which was only published in July. This is, I mean, yes, this is one-off, but we have had one-offs in a number of periods in the past, either from the reduction in corporate taxes along the lines mentioned by Henri, or from the positive resolution of tax audits. The tax rate at 25%, I would say, is slightly lower than what I would have in mind in terms of normalized tax rate, which would be probably closer to 26, but 27, if you measure 27 in the first half of last year, was probably a little bit on the high side. Hedging program on the VAs, the new business margin is calculated on the basis of, more exactly, our pricing strategy is based on the 95% confidence level volatility. And so we are quite conservative on the pricing side. And so we do not see that as a threat to the availability of the product. And we are, over time, more sensitive to how long-term volatility evolves than we are to short-term volatility. Maybe, Kevin, you want to say something on this? Kevin Byrne? Microphone, please.
The short-term volatility we saw in the last couple of weeks really has limited impact, where the program realizes actual volatility over long periods of time, and we don't see that as being a huge consequence. The other comment, I think, was reinsurance related. The variable annuity program and the hedging for that does not utilize or depend upon reinsurance. We hedge that through dynamic hedging internally, and therefore we're not subject to availability of reinsurance if that was the nature of that question.
And I will ask Gérald to take the credit default swap question.
Yes, you asked a question about credit default swap and the impact. As you know, when we are presenting the average rating of our portfolio, of our fixed income portfolio, which is between single A- and single A, this includes the credit default swap. So that means that credit default swap for us is an alternative, as we explained before. It's an overlay of corporate spread that should be added to the large amount of treasury bonds that we still have in our portfolio. Keep in mind that we still have 130 billion of AAA bonds, which are treasury bonds.
Gérald, you said between single A plus and single A, it's single A plus and double A.
And double A, sorry.
Okay. Does this answer your question, Thomas? More or less? What's frustrating you?
No, it's about the credit default swap and the link with treasury bonds. I don't...
Well, because credit default swaps are used to produce a synthetic average credit quality for our portfolio. So what Gérald indicated to you, that the amount of credit default swaps is not relevant for us. We use credit default swap in combination with treasury bonds to produce a synthetic credit quality of the portfolio. Is that fine?
Yeah, thank you.
Okay, next question. Yep.
Yes, hello, Emmanuel Gouet, Exane BNP Paribas. I would like to come back on the slide 53 about, which is an interesting graph about the cumulative credit losses on the subprime exposure. In fact, if I understand, you expect the cumulative credit losses of an average 12% on a long-term view on the vintage 2006. Is it your expectations? And behind that, is it far or very different of what is currently pricing the markets through the ABX index? How it compared to the current market price on the ABX index?
On the vintage 2006, this 12% default expectation is coming from UBS, Gérald, do you want to answer whether this is in line with the pricing of the products? I believe that the pricing of the products, right? I mean, the pricing of the index now is much worse, but we still believe that this is what is going to emerge.
Yeah, that means that it's a view of UBS of what should be the over time, because you see that on the x-axis it concerns the next 10 years. So it's a 12% expected default rate, cumulative default rate. When you take the ABX, and you are referring to the ABX index, of course, the ABX index is anticipating a higher level of default, which could be something towards the 20%, or let's say between 15 and 20%, because the market is overreacting. But nevertheless, the real expected default rate is 12% for the vintage 06. I should also mention, and I'm sure you noticed it, that we don't have any, as far as the vintage 06 is concerned, we don't have any single A tranche, and we have a triple A tranche, so that means that even if we would be at 20%, we wouldn't be at risk. But again, the market presently and the ABX is overreacting to this situation.
Yes, what is happening right now is that there is a reaction, that there is a feeling in the markets that there will be more credit losses, and this is compounded by a liquidity crisis in the market, which pushes all the indexes to levels that have not much to do with the economic reality. We believe that this is going to be, for us, a good buy opportunity, because we believe that some credits are completely undervalued, especially, for example, in the AA or single A category, and we believe that we should. It's in those market turbulences that you can take, that you can make the best investment decisions.
Okay.
Yeah. Yes, it's a little bit amazing compared to the publication of rating agencies that a few months ago in April, S&P was saying that the current trend was between 6 and 8% of cumulative credit losses on the 2006 vintage. So how is it possible that this kind of market can be organized through rating agencies that seem to be far away of, I can say, investors in terms of proactivity in this kind of market?
Yeah, I mean, that's, I would say, your judgment, Erwan. I mean, we cannot discuss what the role of the rating agencies is in the market. I don't think it's the purpose of this presentation. I think the key takeout of this slide is, yes, the 2006 vintage and the losses are going to be higher than in previous vintages, but it's not going to affect the AA or the AAA tranches where we are exposed. And it's very revealing of some sort of, I would say, market opportunities or market inefficiencies, because the pricing is very different from the underlying economic reality, even if the underlying economic reality is not as good as what it was a couple of years ago. So for professional investors, these are very interesting days. I think we'll probably take a question on the phone if we have some before going back. Oh, sorry. Before going back to questions in the room, just to be sure that we have some balance. Does anyone have a question coming from the phone?
We have a question from Mr. Nick Holmes from Lehman Brothers. Please go ahead.
Okay, go ahead.
Yes, hi, it's Nick Holmes at Lehman. Can you hear me?
Yeah, absolutely.
3 questions. First one is going back to the P&C reserve releases. I wondered if you could give us a little bit more colour about what you see as a normal level of reserve releases at this stage in the cycle. 1.6% seems a little bit high for you, but I don't know, maybe that's wrong considering where we are in the cycle. That's first question. Second question is, in German and French motor, do you sense that the cycle is turning and that we might be going into a hard market? And then third question is with Solvency II and also the new S&P model. Just wondered, are you happy the way that diversification is being recognised, and is this going to change the way you manage your business? Thank you.
Thank you, Nick. Denis, do you want to answer, and maybe François is going to say a word on the French market?
Yes, on the P&C reserve releases, what I indicated was that we had positive developments that were higher than the previous year by 1.4 points of combined ratio. So we, if you look at the last 10 years, I think we have had, perhaps except in one half year, positive developments in our past year reserves every year. So for AXA, it is not uncommon to have positive developments on past years. I'm trying to find the amount of positive developments all in all. Sorry. Maybe we can take the French motor question, and I will be ready in a second.
So will you take the French one?
Yes, concerning the price of the motor in the French market, I anticipate, I think that in 2008 the prices will be stable. For the beginning of the year, the decreasing will stop, but the prices, I think, will be stable. Concerning AXA France, we realized a very good year, first semester in motor with more than 60,000 net inflows in motor car, and our combined ratio was stable, so the growth with a good combined ratio, and more generally for the combined ratio in France, we improved our combined ratio, and our combined ratio decreased by 0.5% with a growth for the third consecutive year above the market. And considering the growth in commercial line, we have a growth of 4.4%, and with a very good combined ratio. And if you consider our combined ratio with our peer, excluding construction, the combined ratio of AXA France is 96%, with for the fourth year a growth. I think it's a good performance, and with strong reserve.
So, I mean, this is an illustration of what I said before to Jean. On the German market, I mean, for 2007, we still see some, I would say, marginal price erosion. Interestingly, what's interesting for us is the overall situation of the German market. I mean, the global revenues from the market are I would say, slightly declining. We are growing. We are growing because we think the offer is a competitive one. And we expect that to continue next year. I mean, the situation between erosion and stability in prices, so no real jump up in pricing, but a situation where, as AXA, we should continue to gain ground. In between, Denis, have you found the number?
Yeah. Last year, Nick, we had a difference of 3.9 points between our current accident year loss ratio and our all accident year loss ratio for the AXA portfolio. And for the AXA portfolio for the first half, we had a difference of 5.4 points. This relates to the 1.5 point difference that I mentioned earlier in my presentation. So we have positive developments in all periods. They are slightly higher in this first half than they were in the first half last year. This is a volatile element in our developments from half year to half year, but this is something that you could expect in each period to have a positive development to some extent, but with variations around the mean. On diversification?
Yeah, just an additional word on the property casualty markets, because now you've seen slightly, on the motor side, slightly eroding prices for some years. And some of you may wonder, I mean, is this going to last forever? I think this is pretty, if you look at the general situation, I think this is pretty positive news, in fact, because you have to put that in perspective with the frequencies of the claims. And the general tendency in Europe is to see very good frequencies with the multiplication of the controls as far as speed is concerned. So the situation in terms of frequencies being good, the fact, of course, prices are eroding slightly, but they have been eroding less than the improvement in frequencies. And we think that overall this is creating a picture where the business is less cyclical than what it used to be, at least in continental Europe. And we see that as a positive development. Sorry.
On the diversification, lastly,
May I just follow up with a couple of points on those two subjects that you just mentioned. With motor in France and Germany, I wondered if you might comment at all about the position of the mutuals, whether you think the mutuals are becoming more disciplined in terms of pricing and whether this is an important change in that sector. And then, sorry, Denis, just very quickly on the reserve releases, just to clarify completely, are you saying that the level of reserve releases in H1 is, in your opinion, abnormal, and there is no reason to think that reserve releases might increase at this stage in the cycle? I mean, I think some people might think that releases could increase at this stage in the cycle, but you're not suggesting that that is the case.
On the reserve releases, I would say that they were not unexpected at this stage of the cycle, but I wouldn't tell you that you can build a model for 5 years with that level of reserve releases. I would say that this is something that we, I mean, as the cycle turn has occurred probably 2 years ago, you can expect a little bit more of that, but that you could also expect that they would at some point decline over time.
Very clear. Thank you.
François on the mutuals in France.
I don't know. I don't really know, but I think that the prices for 2008 are going to stop stop dropping. But I'm not sure that they will increase. I think in 2008 we will have flat prices, even if the combined ratio, if the market combined ratio is now at 100%. And the motor combined ratio for AXA is below 100%. It's with a good combined ratio for this activity. But I repeat that in the first semester for AXA, we realized the best year for us with more 60,000 new contracts in our portfolio. So the market is still good. But I think in 2008, the price will be stable.
Nick, more generally, as far as the, I would say the behavior of the mutuals is concerned, first, I mean, it's not going to change overnight. Second, what we can say is over the last 3 or 4 years, I mean, following the 2003 market turmoil, the mutuals overall in Europe have behaved much more sensibly than in most of the previous cycles. Thirdly, what I would say is, now that it's absolutely clear that Solvency II is going to be driven by economic capital models, I think progressively this is going to force the various players, mutuals or non-mutuals, I mean, middle-sized and small players, which can be mutuals or can be in other forms than mutuals, it's going to force them to act more sensibly. And if they don't, the cost in terms of capital for them is going to be higher, because either they have internal models and they will benefit for them, or they don't have internal models, and I think the rules are going to be more stringent. So overall, it's not going to be a positive change overnight, and you can never say that you won't have someone behaving foolishly, but I think the framework is creating a situation which is going to be more difficult for irrational players.
That's very interesting, thank you.
On diversification, finally, what we have seen in QIS3 was that, yes, diversification was taken into account. The limit to that is that non-EU entities, the status of non-EU entities in that is not clear, and we would like non-EU entities to be fully taken into account in the calculation of diversification, and it is not clear that it is the case today. So that's the last remaining bits on which we will try to convince the supervisors and the regulators that it would make sense to look at solvency on a fully consolidated basis, including non-EU entities. As far as S&P is concerned, I mean the rating agencies are concerned, the new S&P model, I have not fully taken stock of the model, but I don't believe that diversification is appropriately taken into account in the model. I believe that for them it's difficult, and the question for them is going to be, are they going to rely on Solvency II to base their analysis? Because if Solvency II is a good economic-based model, why would there be a need for a different rating agency model, which is something that has really been specific for insurance, as far as I know.
Okay,
that's very clear. Thank you.
Thank you. We'll take now 2 questions in the room, and we will continue for the ones who have questions coming from London or the US in London this afternoon. So 2 questions in the room. Yeah, Erwan, I think you've already had the mic. So no, go.
Okay, fine.
Yeah.
Guy Acouvé, Natixis Securities. I have 2 questions, if I may. The first one is still on US subprime. You have give the estimated part of policyholders' participation at 55% of your exposure on US subprime. Can you give us the affectation for the other 45% remaining on that to have the purpose of this part? My second question is on the underlying result. It was useful to have the geographic affectation for the different underlying result. We can see that the UK and the US are a little bit weak this quarter. You have given some details, but can you give us more information on the outlook for these 2 areas in your result? Thank you.
Okay, Guy. I mean, quickly, the UK, UK-US weeks this quarter, I think we've given the explanation in the presentation. I mean, the UK, it's the impact of the floods on the underlying earnings. In the US, it's not that weak, but it's a temporary impact of what has been done on the plus 70 life policies. Denis, do you want to answer the question on the subprime?
Yeah, when we say policyholder participation of 55%, that means that the rest is for the shareholders. So I don't think I need to give more granularity to that. Coming back to the US, we gave a lot of explanations on the US new business value. In terms of the earnings, the US earnings went up by 8%. The earnings were a little bit weaker this year because we had less DAC unlocking than in the previous periods. So this created higher expenses compared to previous periods. I think going forward, this is not something to, I mean, if there are less DAC unlocking in first half 2007, then in 2008 the earnings increase should rebound. So I have no concern for the outlook as far as the US nor the UK.
Okay. Very last question, and then we close the session. Who has not spoken so far? Okay.
Emmanuel Calès, Société Générale. Very briefly, first on your year-end capital gain program, you already secured more than 700. Would you consider, your target is 8 to 1 billion, 800, would you consider an increase of this year-end program? Second point on Winterthur, could you come back a little bit on the momentum on Winterthur in Switzerland, especially on the motor individual? And the last question I will ask later because it's slightly longer. Thank you.
Okay, fine. On the capital program, I mean, we have given a range. You've seen that we have 7 billion of capital gains attributed to shareholders, which makes us very comfortable. So, I mean, we expect to reach at least the range, but we are not going to be more specific. On the Winterthur situation, Motor Switzerland, the evolution of the portfolio so far is absolutely in line with what had been seen in the previous years. And what I've been saying in the presentation is that, I mean, for us, the subject we want to handle is how can we accelerate the growth of this portfolio. You shouldn't expect that to happen overnight or to happen in one semester. Or I mean, you have to put in place structural elements which are going to change the aggressivity of the networks and the content of the products. We are working at that. In Switzerland, like in Germany, the renewal campaigns are pretty important. Between September and January, I would say most of the new business for the year is done. So we are planning things between September and January to try to, already this year, it was not possible last year because we are not the owners, but to become slightly more aggressive. So it's something which is going to build between 2007, 2008, 2009. But we think it's going to come progressively. And if you look at what we have achieved in Belgium and in Germany in this respect, I think there are reasons to believe that there are some things which have been successfully applied there, which can be reused in Switzerland. Okay. Thank you very much. Thank you for the question. And as we said, of course, we will continue this afternoon in London.